So Chapter 9 is all about project and capital budgeting. So when we think about capital budgeting, again, we're talking about cash flows. This is a recurring theme over this whole entire class, right? We want to know, where does the cash come from? Where does the cash go? So here we're looking at it from a capital budgeting standpoint. So there are three categories that cash flows fall into in this capital budget process. We have the initial cash outlay, ongoing cash flows, and terminal cash flows. So when you decide to take on a new project, there are some initial cash flows that are required to get us started. So it could be purchasing a piece of equipment. So if you're expanding a product line, you probably need new equipment in order to manufacture that product line. There could be initial development costs for the research. And then there's generally some kind of net working capital increase because of having to increase our inventory or increase raw materials to produce this new product line. Then once that product line is up and running, or this project is up and running, we've got ongoing cash flows. So the first of those is incremental revenue. So this is just the revenue that is generated from this project. So it's incremental in addition to the other revenue that we have. There are other product lines, right? This is incremental just from doing this project. And then you also have costs associated, the ongoing costs of running the project. You've got taxes, and then you potentially have changes in net working capital as things fluctuate in inventories and accounts payable and accounts receivable. Then when we shut a project down, we've got some cash flow. So one way of thinking about shutting a project down is if you're on a construction site, right? Let's say you bought a piece of land and you build a bunch of houses and you're done building houses, but there's that trailer sitting there that you have been working out of, and there's a showroom that you've been working out of. So the terminal cash flows come from your shutting down of that project line. So you could have to sell equipment that you no longer need. You could have shutdown costs. That example I just gave, right? You would have to move those trailers, and you may sell them or move them to another location. And then you could also have decreases in working capital due to winding down this project. You don't need as much inventory. We want to take a minute and differentiate here between operating expenses and capital expenditures. So an operating expense is something that's going to show up as an expense on your income statement. It is not capitalized, it is immediately expensed. Right? Remember that matching principle, expense all the items that were incurred in order to help us generate the revenue. A capital expenditure is something that is going to be capitalized. It's going to go onto the balance sheet and then be amortized or depreciated. Right? So these are generally large expenses that are going to benefit us over a long period of time. So it's really important to remember that operating expenses are what's showing up on your income statement, but not every operating expense has a cash flow associated with it. So depreciation expense does not correspond to the actual cash flows. Remember, when we buy a piece of equipment, it's going to be capitalized, going on our balance sheet, and then we're going to depreciate it over the useful life of that asset. So you'll see on our income statement, we'll have straight line depreciation expense every year for that new piece of equipment. But there is no cash flow associated with that. The cash flow that corresponds to this new piece of equipment is happening here in year 0. And it's not happening in our capital or cash flows from ongoing. It's happening in that initial cash outlay, cash budget. So here we have these operating expenses for plant redesign. This would be an example of development cost that are happening in order to get this project up and running. So when we are considering those incremental revenue and incremental costs, there's important things that we need to consider. The first one is a new product line is not going to take off immediately. It generally has lower sales in the first initial periods, and then it ramps up over time. Average selling price of a product and its cost of production will change over time too, right? Hopefully it gets cheaper to produce over time as we get better and more efficient. And then for most industries, competition tends to reduce profit margins over time because as competition comes in, they will try to undercut us from a pricing perspective and drive down our price, and then that cuts into our margins. So we're starting to build this framework that is showing how our cash flows are going to happen. So we've got incremental revenues and then our incremental cost. We also have depreciation, which is going to decrease our net income. Now, you're going to sit here and say, okay, well, depreciation is a non-cash expense. And you're right. But we need to keep it here right now because we're going to need to use it to calculate our incremental income so that we can accurately calculate the incremental taxes. Then at the end, we'll add that depreciation back because we know that this is a non-cash expense. We're not quite there yet. So equation 9.1 here will allow us to calculate the incremental earnings before interest and taxes, EBIT. Maybe we take the incremental revenue, subtract the incremental cost minus the depreciation. Then from that, we can use that to calculate our tax liability. Then we can calculate the corporate tax rate, or using the marginal tax rate, we can calculate the income tax that's associated with this incremental EBIT. So we're going to take that income tax is going to be equal to the EBIT times the firm's marginal corporate tax rate. That'll be, and this is always given the tax rate, right? The last slide we calculated EBIT. Now we can calculate the income tax. So this slide puts together everything that we've done so far. And you can use equation 9.3 to get to this incremental earnings down here, the bottom line. Now note, there are no incremental revenues in year zero, right? Because we're just starting the project. We have costs in year zero, but no incremental revenue. So that means we have a loss in year zero, but then positive earnings in years 1 through 5. Notice these are not cash flows. We'll get there. Over the next 9 slides, we'll work through an example here. So suppose ABFan is considering the development of an Internet of Things appliance called IOTA. The major competitor for IOTA is a product being developed by Moon Corporation. So based on a bunch of marketing surveys, the sales forecast for IOTA is 4,000 units per year. This is, you want to be careful here. This is a quantity, not a price. They expect the product will have a 4-year life and an expected wholesale price of $200. Actual production will be outsourced at a cost of $90 per unit, right? So cost of goods sold is going to be $90 per unit. We're going to sell it for 200 units, and we're going to sell 40,000 units per year. So we have some more information before we can actually get started. To verify the compatibility of the IOTA system as they become available, ABFan must also establish a new lab for testing purposes. They will rent the lab space, but will need to purchase $6.5 million of new equipment. The equipment will be depreciated using the straight line method over a 5-year life. So we're going to take the $6.5 million divided by 5 years to get the depreciation expense per year. And then our last piece of information is the lab will be operational at the end of year 1. At that time, they will be ready to ship. So they'll have the goods ready to ship. They expect to spend $2 million per year on rental costs for the lab space, as well as marketing and support for this product. Our job is to forecast the incremental earnings for this project. So we need to calculate a couple different things here. First, incremental revenue, incremental costs, and then on the next slide, we'll handle the next thing. So incremental revenue. So we have additional units sold times the price. So quantity times the price. Okay, is going to give us revenue, P times Q. So if we sell 40,000 units at a price of $200 each, we'll have $8 million in incremental revenue each year. Incremental cost, the quantity times the cost. So quantity times the cost is going to give us our cost of goods sold. Now, this can get a lot more complicated than this. As time goes on and your inventory costs change, you would have to then determine and you could be more accurate in your forecasting if we had information about whether we're using LIFO, FIFO, or average cost. We're not going to have to worry about it in this example, or for that matter, for the class. So 40,000 units, cost of $90 each. We have $3.6 million in cost of goods sold, or incremental costs per unit for each of in total for the 40,000 units that we're selling. To finish out the incremental costs, we also have these selling, general, and administrative expenses which is the $2 million for the marketing and support. When I gave you, a lot of times this will also be referred, all of this is lumped together as operating costs. It doesn't matter to me how you label it or identify it, it's all the same thing. Okay, depreciation, the formula is not showing here, but it shows on your sheet. Okay, we're going to take the cost of the asset and it's divided by its useful life. So in this case, right, the asset has a useful life of 5 years, but the project is only going to last 4 years, but we still have to depreciate it over its useful life. So we must account for that final depreciation charge in the 5th year. And then they tell us that our marginal tax rate is 40%. So we can use all that information now to put together our spreadsheet. So they're lopping off the last 3 zeros, so they're putting everything here in terms of thousands. I would recommend that you do that also. It makes the numbers a lot easier to work with. So $8 million in revenue each of the 4 years. Then we have the cost of goods sold at $90 per unit to get the 3,600. So we have gross profit, when we subtract revenue minus cost of goods sold of 4,400. Then those operating expenses of $2 million per year for the 4 years. And then we have that 5 years of depreciation expense. Right? I know the project is only creating revenue for 4 years, but that depreciation, because the asset is over 5 years, we need to include that 5th year. So then we can calculate earnings before interest and taxes. We had a 40% tax bracket. So we have incremental earnings for each year. Okay, this is not cash flow yet. We're going to get there. And they asked us to calculate incremental earnings based on this project. So we have, for each of the years, we have the incremental earning per year. So a couple things to consider, and I've said this and it's really important, I'm going to say it again, the incremental earnings are an intermediate step on the way to calculating the cash flows. That would be the basis of our analysis of this project, so we're not done yet. The cost of the equipment does not affect earnings in the year it is purchased. That's time period 0, but it does but does so through the depreciation expense in the following 5 years. So that's important to remember and keep in the back of your mind. Another reminder about depreciation is it's based on accounting rules. So in this case, we have to follow the accounting rules. It says this asset has a 5-year useful life. But for corporate finance purposes, what we need is to take into consideration the value of the cash flows over the project. So here the equipment is going to be used for 4 years, right? But is going to depreciate over 5. So that's going to change our taxes, which is why we have to keep that in consideration. We also have to include it. Lopping it off is going to cause problems. Don't try to save time there because it's going to end up that could cause you to make a bad decision. Ultimately, what we're trying to get when we're analyzing projects is free cash flow. So what is free cash flow? It's the incremental effect of a project on a firm's available cash. So again, we're going to have to take these capital expenditures and depreciation into consideration. I keep saying we're coming back to it. Here's where we get back to it. So as you look at table 9.1, this is a really good example of how it's going to cause problems if you do it incorrectly. So we have an example here where we have incremental gross profit of $1 million. We subtract the depreciation to get earnings before interest and taxes. We calculate our taxes. We get incremental earnings. This is what we've talked about up until this point. Now, right, we're going to add back that depreciation because it's a non-cash expense. And that's going to give us where we've been going the whole time is this incremental free cash flow, right? So you have to add this back. If you don't do that, right, you can see here in this incorrect example where they didn't do that and their incremental free cash flow is undervalued by $40,000 because it should be $840,000 and they're only coming up with $800,000. So it's really important, right, that you take that depreciation out so that we can calculate taxes properly and then you add it back in. If you don't have it in there, you're going to mess up the taxes, which is going to mess up your incremental free cash flow. So memorize this template, but you don't have to memorize anything except right here, because up to this point, you should have already memorized that income statement. The only thing that's different here is this is earnings after tax. Now we're going to call it incremental earnings because we're looking at a specific project, right? And then we're going to add back the depreciation to get incremental free cash flow. So we saw it in that very first slide, this net working capital. So let's define what it means. It is the difference between your current assets and your current liabilities. Now, that can be a pretty large for a big corporation, the number of accounts that you need to include there. You can also simplify it. And for our purposes, this will be a much easier definition to follow, or it won't be too many different things to keep track of, but cash plus inventory plus receivables. These are things that are going to be that we can specifically call out for that project, and then minus our payables that are associated with that project. So if at all possible, work off of this formula. If not, then you can also work off of this. But if you have the information about cash, inventory, receivables, and payables, use this formula. Now that we can calculate net working capital, what we're really interested in is how did that change? So what is the change in net working capital from one year to the next? All right, so we can use equation 9.5 here. It's net working capital at time t. Right? What is our expectations for net working capital this year minus what were they last year. T minus 1 would be last year, right? One less year than where we are today at year T. Equations 9.6 and 9.7 just put together everything that we've done to date through this chapter and summarize it in these two formulas, both giving us free cash flows. Having capital equipment and depreciating it over time results in this depreciation tax shield, right? Because you are reducing your income by the amount of the depreciation, right? Because depreciation is an expense and you're spreading that expense over the time period that you're going to use that piece of equipment. So that reduces our net income, which it reduces our earnings before interest and taxes, and therefore it's going to make our taxes lower. So it results in what we call a depreciation tax shield. So if you take the tax rate and multiply it by the depreciation, it tells us the amount of the tax shield that it provides. So now we're coming full circle, because remember we did net present value earlier this semester. So we could now use these cash flows that we've developed in the first half of this chapter to calculate the net present value for a project. Remember that net present value is just the present value of the cash flow. So in this case, we're using the free cash flows at time period T, and we're going to discount them at 1 plus R to the T. So 1 plus the interest rate to whatever time period it is. So we have, multiple years of a project, and then we have to bring them all back to 0. We'll subtract that initial cash outlay and we'll determine whether, right, the question is the net present value of this project greater than or 0, right? That's our decision rule. So we want to know if it's greater than 0. So back when we did net present value before, you were just given the cash flows, right? Now you are developing the cash flows on your own for this project, and then we're going to apply the net present value method just like we did before. So there are 3 other effects on incremental cash flows that we need to take into consideration. Okay, the first is opportunity costs. So opportunity costs are the value of resources that could be provided in its best alternative use. The value of a resource that could have provided in its best alternative use. So because this value is lost when the resource is used by another project, we should include the opportunity cost as an incremental cost of the project. Okay, so include, I'll put an I, right, for include the opportunity cost. For project externalities, this is the indirect effect of a project that may increase or decrease the products of other business activities of your firm. Right, so if you introduce a new product line, let's say you are a car manufacturer and you introduce a new SUV, it might affect the sales of your other SUVs, right? If a smaller SUV or maybe a larger SUV, right? But it could take away sales from some of that. So that's called cannibalization. So the lost sales of an existing product are an incremental cost to the company of going forward with a new project. So therefore, we should include those incremental costs of cannibalization. So I for include again. All right, sunk costs. So this is another economic term, just like opportunity costs that you've seen before. So sunk cost is any unrecoverable cost for which a firm is already liable. So because it's already an unrecoverable cost, there are no incremental costs with respect to the current decision and should not be included. So don't include. I like my writing. It's not very good with a mouse. Wish they had a chart for this, but they don't. Then your chapter gives you 3 examples of sunk cost with an example of fixed overhead, past research and development, and unavoidable competitive effects that you can read about. When we've calculated the net present value, we simply can't stop there. We need to have a sense of confidence that we are making the right decision. One of the ways that we can do that is through sensitivity analysis. So everything that you've done so far has been a projection, right? We don't have a crystal ball that's going to tell us exactly how much the sales are going to be and how much each item is going to cost, right? We have estimates and we have a pretty good idea, they're ballpark. But one of the things that we can do is do a sensitivity analysis to see how our net present value changes if we change a single underlying assumption. Okay, so you want to do multiple analysis, and this is one of the reasons Excel is so powerful. So if we decide to change one thing, you change that one thing in Excel and it automatically does all the work for you. Right? You don't have to recalculate every year's net cash flow. If we decide, for example, that instead of our operating costs being 2 million, they're 2.1 million, right? We just change the 2.1 million, 2 million to 2.1 million, and everything automatically rolls through, which is where the value really comes in Excel. And if you set the problem up right, then it's really easy. You change one value, you see what the new net present value is. So often what will happen is we will have an initial assumption, which is kind of a middle of the road ballpark estimate. And then we'll have a worst case, right? If things don't go right, and a best case. If everything goes right and everything comes out the way we think every economic factor is in our favor, then we would have that best case scenario. So you can see here, right, where we have these 3 different cases, and each case has its own set of numbers, that if we can get this worst case to be, or all these, the worst case to have a positive net present value, then you really have some confidence that this project will not lose money for the business. So what this graph shows us is the best and worst case scenario parameter assumptions in a graphical depiction. So what we can see here, right, bottom is our net present value of our project. So anything above a $0 net present value is going to work for us, right? So this is our worst case unit sold of 35. Right, we're going to end up with a negative net present value, right? Because here, this is a negative number, right? But for every other case, right, we're going to end up in this positive range. And this positive range is pretty big, right? To all the way up here to the 65 units sold, and that's in thousands. So, right, this gives you a really good sense of looking at how these parameters change, and a pretty good level of confidence that unless the absolute worst case happens, and only for the worst case is it in the quantity of units sold that is really bad, right? If we're down to 35, it's not good, but anything above that, right, we're going to be in a positive net present value situation. So that gives us a level of comfort that we should probably go ahead with this project. Something else that may be of interest to the firm is looking at their break-even analysis. So something else that is always considered is, how much do I need to sell in order to cover all my fixed cost? Well, we're not breaking this down into fixed and variable cost. So your chapter is defining it as what is the level of a parameter for which an investment has a net present value of 0? So we can look at each of those individual parameters and determine what it needs to be that would make our net present value 0. And remember, anything above that parameter that is going to make it a net present value above 0 would be a good project. So you can see, again, this helps with the depth of how much we can change and still be in that range of this is a good project for our firm. So from an accounting break-even standpoint, we're usually looking at EBIT, earnings before interest and taxes, and EBIT is a break-even. Break-even is when EBIT is 0. So if we take our units sold, another way of saying this is revenue, because units sold times the price times units sold times the cost. It's revenue minus cost of goods sold minus the operating cost minus the depreciation. What is that gives us 0? All right, so we can modify each of these variables and use a formula in Excel that helps us determine, a solver, how much do we have to sell in order to break even, right? In order to cover all of these costs that aren't going to go away if we don't do this project. So scenario analysis is a capital budgeting tool that determines how the net present value varies as the number of underlying assumptions are changed simultaneously. Now, you don't want to do this by hand. This is one of the reasons you're learning how to use Excel as you go along. So you'll have a problem for homework that does this sensitivity analysis, but I won't ask you to do it by hand, right? But you're still calculating the net present value. You're just changing one parameter at a time and seeing how that changes the net present value based on, a couple different iterations of that. So your chapter gives an example where it's looking at a current strategy. We have a sales price of $260, and if we sell it at $260, we expect to sell 50,000 units, and we get a net present value for that project of 4,636. Okay, then we can say, okay, what happens if we reduce the price? Price comes down. Sales price comes down. Well, what do we know about supply and demand? If the price comes down, usually that's going to increase demand. What does that do? Right? We've put all of that into that Excel spreadsheet. How does it affect the net present value? Well, in this case, not good, right? Our net present value comes down. What happens if we have a price increase? Right? If P increases, it's going to drop the number of units that we sold, and that's going to give us a net present value that is lower than our current strategy. So that tells us, right, that we want to stick with the current strategy. Now, it's not always going to be the same that these two numbers end up the same. So don't make that assumption just because for this example that they did. And it's not always going to be that a price reduction is going to reduce the net present value and a price increase is going to reduce the net present value. It won't always work that way. It is very case specific. But in this case, based on the numbers, the current strategy is the way you want to go because it gives us the highest net present value. So finally, we have some options in capital budgeting that we may want to take into consideration. There are no problems, but you do need to know that they exist. So a real option is the right, but not the obligation, to take a particular business action. If you have the option to delay, right, you can time a particular investment based on current market conditions. If you have the option to expand, right, you can start with a limited production and then expand only if it turns out to be profitable or successful. And then you also have the option to abandon, right? You cease investing in a project. And that can happen when it's time to, if things aren't working out, or it's there's a new technology out or new research out. Right? This happens all the time with drugs. The new drug comes out, right? We're not using the same cancer therapies that we were using even 5 or 7 years ago for some cancers, right? Because new things come out. So you have this option to abandon if there's something new that's out. You don't want to keep producing the same thing if no one's going to buy it. So that concludes chapter 9. We're getting there.